Always a pleasure having you with us here on CNBC-TV18. Arvind Sanger is now joining us, Managing Partner at Geosphere Capital Management. It's going to be a big day, perhaps new highs for the markets. And why not, right? Is the reverberations of what the Fed did last night and what they said, that continues to be felt in Asia this morning. So, for example, the US 10-year is now below 4%, Arvind. Just incredible, the pace at which this has happened. Your thoughts and what this means for markets. One thing, I mean, of course, it means markets go up for now, but it is also notable that they are saying that rate cuts are coming, even though their own projections of GDP growth, etc., still remain to be pretty robust. So are they seeing something happening or this is just keeping options open? In any case, I thought, I mean, it was extraordinarily dovish what we heard overnight. Go on.
Yeah, well, two things. One is interest rates were, 10-year yields were just above 5% in October. Short 2 months later, they're carrying a 3 handle. So that's been a dramatic improvement in financial conditions. And the surprising thing was, at least to most of us, was that Chairman Powell did not push back against the easing of financial conditions. In addition to the dot plot being more dovish with the 3 cuts predicted for next year and no more rate increases, he also did not try to talk the market down by implying that maybe people should get too excited. He said financial conditions are easing, that's fine. I mean, he didn't quite say it, but he implied it. And the reality is that they are predicting only a 1.4% real GDP growth next year. So I think the Fed may be surprised. So, we can pick long-term flies in the ointment. My view is that with the financial conditions having eased as much, probably GDP growth might prove to be more resilient than what the Fed is forecasting. And if that's the case, inflation may not come down as much as they hope that it will. But all of that is for another day. Today, the reality is that the market is risk on. There is no data between now and year-end that can upset this rally in a meaningful way. Therefore, the market is going to rally. And I think that applies as much to risk on global emerging markets and India as it does to U.S. markets. So I think that's the mood today. And Fed clearly did, signal a much more dovish outlook. And their view is that inflation is coming down so fast that they need to start cutting in advance. And this was another very important point he made. They don't have to wait for 2.5 or anything. He said that given the lag effect, they can start cutting if they think that it's going to get towards 2 in a few months. They can start cutting early. So, there's a lot of things that were said today which were very dovish.
Okay, by the way, look at the market pre-opening, right? I mean, it's going to be a big one today. The markets are vibe right now. I mean, 21,000 on the Nifty, holding steady, 100-point gap up is what we're looking at. There's an alert. My director just alerted me to the fact that the 10-year yield is open at 7.21%. This is, of course, the Indian 10-year yield. The US 10-year yield is below 4% now. So, lots of positives coming through. I just want to take a moment to tell you about the stocks that are charging ahead. We spoke about the IT names. There was short covering yesterday, and that perhaps is something that can continue today. We spoke about the banking names. There is all rate sensitives, real estate, auto stocks. Remember, if rates move lower, loans will become cheaper, and hence real estate stocks, auto companies, could benefit from that. So big moves coming
so
in over there.
Look at the rupee. The yield is down about 5 basis points, but the rupee is, it's a massive move coming through on the currency. So 83.27 compared to 83.4. So that is what, a 13 paise strengthening of the rupee, which you're seeing because the dollar has come off. And actually, the Fed is like the Pied Piper. Yeah. They started this entire rate hiking cycle, and now if they're indicating that, rate cuts are coming, others will follow. I mean, maybe some will preempt, some will wait for them to cut, but I mean, that's essentially it's a big global signal as well.
It is.
Because the 10-year is like the risk-free rate. I mean, actually, it is the global risk-free rate, and that is now under 4%, as we said.
Absolutely. So, Arvind, hi, good morning, and thanks for being with us. The question that begs asking is, what do you do now in this market? If you've perhaps missed out on this rally, or even if you've participated so far, do you top up at this point, expecting a further expansion in the Indian markets? Because we have big events upon us, right? There's the elections as well. So what do you do now?
Well, I mean, I think that you have to buy sectors that have lagged where there are opportunities still. We think, the domestic healthcare is one where we are finding opportunities. We think maybe it's time to look at some of the bank stocks that have been laggards all year. And also, we've stayed away from the IT names, but that's an area that we have to re-examine if, the financial conditions are easing as much as they are, then that's going to be good for the financial sector in the U.S., and that eventually should mean, some tailwinds for IT companies. Although, we want to be careful. Again, it's not going to be a huge IT rally, but sectors that are well positioned for the whole transition towards AI. Some of the companies more in the mid-cap space, and maybe some of the large caps in IT that are better positioned. So I think there are sectors that have lagged, and that's where we would be looking for incremental money to work. Obviously, all the indices are going to go up, but banks are heavyweights. They could lead. IT has been a laggard. They could continue to have room. So I think the market will probably see, in the metals area could be another beneficiary, although that's a little more China dependent. But I think there are areas that could benefit, and so therefore this market could have another leg, which is driven by other sectors that have lagged.
All right. Hi, good morning, Arvind. Nigel on this side. Arvind, the markets have seen a good rally. How much of the good news is in the price? We have this, BJP continuation in 2024 that the markets have seen a good uptake out there. Now you have the Fed that is dovish. How much of it do you think are, both these two are the big cues, right, that we have moved up? How much of that is in the price on the headline index?
Well, that's a tough one because, the indicators that make us uncomfortable are things like, IPOs of these small cap companies that are getting bid up 50, 100 times. Those are the kind of indicators that suggest that the market is very frothy. So, you have to be careful in terms of chasing after the small and mid cap, which has actually moved even more than the large caps. And that's where some of the froth lies. So maybe, playing it a little more carefully with some of the larger cap names in some of these sectors that have lagged, rather than chasing after some of the small caps which have had huge moves. So I would definitely move a little bit more up the quality spectrum because the rally is not young. The sectors are not cheap, most of the sectors from a historical standpoint. But, this is a long-term growth story, so I don't want to get off the growth story. I just want to take a little more risk off the table in terms of portfolio mix, if you will.
All right, we leave it at that. Arvind, thanks a lot for joining in. We have a market opening in less than 10 minutes from now, and it looks like it's going to be a solid one. 180 points in the green. This is really the election moment for the Indian markets as well. I mean, the US Fed saying that there's going to be 3 rate cuts, something that the street was not estimating. So